I want to take a look. I want to walk you through a client that has come to me at the beginning of their business, and we're talking about what kind of money that they're going to be making and what kind of entity that they should be for their type of business that they're going in. Sally came to me and she is starting a new venture, something she has never done before, and she wants to be a consultant. She's going to consult people that are big in social media on how they need to handle things in their social media world, whatever they need to do. She wants to be a consultant for that. So when she came to me, we set her up for an LLC. She went through her state to do that. And then we talked about how much money she thought she was going to be making, especially in that first year, just starting out. So at that point, she's like, I really have no idea. I've never done this before. So she's really hoping that she can show a profit the first year. So at this point, I'm really going to suggest that she stays an LLC sole proprietor. She'll file a Schedule C on her personal return just to gauge how much money she's going to be making in that first year. So at that point, she's going to come back to me when it's time to file her taxes. Unless at any point during that time she's like, oh, this is making so much more money than I ever thought. We've got to talk. Let's say she comes into me in February of the next year. It's time to get her taxes done. So at that point, we want to take a look and say, okay, income minus expenses, your net income is $50,000 for your first year. Nice first year. But at the end of that last year, she saw things really picking up. She's thinking for the next year, the year that she's in now, she's really going to likely have a net income of $100,000. So at this point, I'm saying, all right, let's talk about different entities. So we have different entity choices. We've done a separate video on that. So if you want to know all the ins and outs of those different entities, go check out that video. But today I'm going to say, okay, Sally, let's take a look of if you're right now, you're an LLC sole proprietor. What happens if tax-wise, if you become an LLC S-Corp? So let's walk through how that looks for her. We're going to say that she's going to have a net income of $100,000. So if she stayed an LLC sole proprietorship, this can also work for a partnership. So if you're along those lines also, this is the same tax effects. So net income, $100,000. We're also going to assume Sally is married, but her spouse doesn't work. It just takes a lot of the other guesswork out of this. So she has a net income of her business of $100,000. One thing to note is she has to pay Social Security and Medicare on that $100,000 on top of her federal and state taxes. Well, half of the Social Security and Medicare that she owes is a deduction. So we're listing that right here as a deduction. So we're going to minus off that, the $7,065. She gets a standard deduction. So she's married, so it's $24,800 at this time of the filming. This changes with inflation each year. And then so that makes her taxable income $68,135. So the Social Security and Medicare tax she's going to pay is $14,130. Federal taxes are $7,781. So her total tax due, and granted these are rough numbers, is about $22,000. She may also have to pay state taxes, but that's depending on the state that she's in. So we're at 21,000, we'll just call it 22. So that's what if she stays a sole proprietorship and she doesn't want to go the S-Corp route. So now let's take a look at what happens when we become an S-Corp. Become an S-Corp, we have to file a form with the IRS saying that we want to become an S-Corp. She also has to pay herself a reasonable wage through a W-2. She becomes an employee of her company. So we have to have the conversation of what does a reasonable wage look like for Sally? She's never been a consultant before. She's not done this business before. So you're like, how do we figure out a reasonable wage? Well, we want to go back and we want to take a look at what was Sally making before she became a consultant. We can gauge what Sally is worth, reasonable wage, off of that. Some people that they're in the business, let's give a small little tidbit example about that reasonable wage real quick. If they were already doing the same thing that they're doing now for someone else, but now they're in the business for themselves, you really probably want to gauge off of what they were making doing that. Also be like, okay, well, they were making $30 an hour the previous place. They went into business for themselves, probably better stay around that $30 an hour mark for a reasonable wage. The IRS does not give us a good definition of what that is, so we're just going off of what we have to work with. So the last job Sally had, she was making $50,000. So we're gonna say her reasonable wage would be $50,000. So now let's take a look at what happens tax-wise with that. Reasonable wage, $50,000. Side note to that is she's still, it says it's on a W-2, she has to pay Social Security and Medicare half of that. It's gonna be withheld from her check just like any other W-2 employee. Net income of the company, we were over here at 100,000. Well, the 50,000 gets to be a deduction, plus the company gets the other half of Social Security and Medicare as a deduction as well. So that actually makes our net income of the company $46,175. We aren't having to pay on our personal return because this is a flow-through entity. We don't have to pay, have that extra half Social Security deduction right there. We still get our standard deduction. So it actually makes our taxable income on our personal return $71,375. So federal taxes are $8,170. You can go ahead and talk about the fact that Sally still has that half Social Security and Medicare right here that she's paying. So that's there too. And then the company's paying the other half. But in reality, she's saving about $10,000 in taxes. So let's go back and talk about this a little bit more in detail. When you become an S-Corp, your net income of your S-Corp right here does not pay Social Security and Medicare. Another thing that you may be thinking in your head is, well, what if I leave that money sitting in the company? Do I have to pay taxes on it personally? The answer is yes. Even if you don't take out the $46,000 out of your company and take it in personally, you still are paying taxes on it. So you can choose to let it sit there and build up in your company for cash or to do whatever you need to do in your company, but you're still paying taxes on it in the year that you earned it. Another question you may be having is, well, how do I get the $46,000 out of my company because I'm not taking it out in a W-2 wage? That's my $50,000. Well, you can take it out as what's called an owner draw. You write a check to yourself personally. It's not a deduction to your company. It's not income to you personally because the $46,175 is what you're paying taxes on. Once you get to the point of becoming an S-Corp, it's always good to sit down with your accountant, have the conversation, make sure there's something you're not missing. If you want to know more tax benefits or more things that have to do with becoming an S-Corp, go check out that other entity video that breaks it down a little bit more. Thanks and have a great day, and make sure that you remember to like and subscribe on our channel.